The potential impact of trade tariffs is creating wide-ranging uncertainty for the markets. So what should investors be keeping in mind as they try to navigate these choppy waters? Joining us now to discuss is Jitanya Kondari, Deputy CIO of the Solutions and Multi-Asset Group, co-lead portfolio manager for the Passport Equity Strategies, and head of macro and thematic research for the emerging markets equity team at Morgan Stanley Investment Management. Jitanya, welcome. I wanted to make sure I got that out before we jump in. Thanks for joining us.
Thank you for having me.
And as you've heard in the markets, U.S. trade policy, of course, is causing a lot of uncertainty in the markets. And there's a belief that in the markets that tariffs will eventually lead to higher interest rates, higher inflation and higher interest rates. But you say that this isn't necessarily true. Walk us through your thinking.
Sure. So I think, tariffs equals inflation is linear thinking, and market relationships are rarely linear. So I'll tell you a couple things. One is a lot of these tariffs can actually act as a tax on domestic production, right? Because a large part of these tariff goods are intermediate goods that are further recycled back into the global trade system. Secondly, you can have retaliation by trading partners. So all of the issues related to tariffs can actually lead to a growth slowdown and hence a lower inflation rather than the other way around. That's one. The second thing is, I think there are several offsetting mechanisms, right? The currency weakness of the country that is tariffed is one way to offset some of that increase. You have corporates that can absorb these in their margins. Supply chains diversions can happen, and demand displacement of certain products can also occur. Just like we saw in the 2017 trade war, the RMB depreciated by nearly 13% to offset some of that tariff impact. So there are offsetting mechanisms built into the economics of the world and of trade that can lead to the tariffs actually not being so inflationary. And lastly, let's see what the evidence is from 2017 tariffs. And if you look at this chart, it's interesting. Canada shows that the U.S. import price change from 2016 has been the highest for Canada. There is an issue here with oil prices because U.S. imports a lot of oil from Canada and oil prices have gone up significantly. That's why that huge jump. But the most tariffed country in 2017 was China.
That's interesting because you see the chart there that China, import prices are way down.
Down. So despite all those tariffs against China, today, U.S. is importing Chinese products at lower prices than 2016. Again, this is because, of course, China has excess manufacturing, which has led to price deflation, but also the currency impact with a stronger dollar and a weakening RMB that has helped offset it. So too much linear thinking in the markets, and I think you really need to kind of see the nuances here as an investor to position across different countries and themes that the market rhetoric is getting worried about.
I've gone through your report and you talk about, you focus on three S's right now. You talk about subsidies, sanctions, and security. What are you seeing with these trends?
Yeah, so I think subsidies, sanctions, security, these are reshaping the political, economic, and corporate landscape today, right? Because on the geopolitical side, right, this is subsidies is leading to this protectionist attitude across countries. There are sanctions that are being imposed, and there is security needed with defense in different countries becoming a priority, with cyber attacks and that becoming a priority with corporates. So these three S's are really reshaping the investment environment. And I just like to say that, as much as people think that subsidies can really lead to onshoring and lead to clustering of industries and better growth, it's important to check the long-term impact of subsidies, and that's really debatable. So, and interesting research on the academic side has shown that subsidies actually can lead to distortion in markets and lead to reducing competition by overproduction in the subsidized industry. And as much as you can increase productivity in that industry, that increased productivity can be offset by reduced productivity in the other areas where capital is taken away from. So it's mixed. Even though sanctions are used politically, it's interesting that only 13% of unilateral sanctions in the last 5 decades have actually been fruitful. So the economic implication is not, again, so direct and linear, and we have to be really careful on how these are used. And just corporate level, government level, and personal level security is become very important with increased threat vectors globally, and that has interesting implications for the way we're thinking of market investments as well.